The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gents. Thanks for joining us today. Can we just do a show of hands to see if you can hear us before we kick off the webinar? If you can just raise your electronic hand. Okay, we're getting some good feedback. Everyone can raise their electronic hands, then we can at least kick off. It's looking good. Looks like we've got most of you guys hearing us, and hopefully you can see us. We are sharing our screen, so you should be able to see what we've got up here. My name's Chris Rule. I come from CoreShares, and a big thanks to Shaun and the team from Easy Equities for inviting you guys to today's webinar. We're going to try and keep it short and sweet. We're aware this is sitting over your lunch break, so you know the shorter and sweeter the better. If you've got any questions, please ask them. We may take them in the actual webinar, or we may wait till the end. Depends what the questions are. So, as I said, I come from CoreShares, and really today's not about any ETFs or any product. It's a cool topic, WTF, what the fact sheets. So basically, we want to just try and give you guys some insight into what the fact sheet's all about and why it exists and etc. By the way, it's not even called a fact sheet anymore. Fact sheet was a cool name. It's now called an MDD, which was the FSCA, who was the FSB. It's a cool way of saying this is a fact sheet, but fact sheet is a minimum disclosure document. So if you're looking on someone's website and you're not seeing fact sheet, but you're seeing MDD or minimum disclosure document, go for that. But we still call it a fact sheet. I think it's a much cooler name. That is the official name of them these days. So we're going to have a look at what exactly a fact sheet is, what the information is telling you, and how you can interpret it properly. Really simple stuff, but really important for you as investors to understand exactly what you're buying. So the quick facts, usually at the top of a fact sheet, there'll be something that says fund information and it talks about some quick facts. And you'll see things like classification, benchmark, launch date, etc., etc. Some are super self-explanatory, so I'm not going to go into the detail. Like the launch date is obviously the date that the fund was launched. But things like classification is important for you as investors to understand exactly what kind of fund you're buying. So in this instance, it says South African Equity General. By the way, we're using our top 50 ETF fund as an example here. And what that means, South African General Equity, is that it fits into a category of funds that buy equities or shares on the South African market. Now, that category says that you must have at least 75% of your fund invested in South African equities. So just that first line is actually telling you a lot about the fund, about what the fund is all about. The next thing you'll see is the benchmark. In the ETF world, the benchmark means what is this fund tracking? What is the objective of this fund? And it's the S&P South Africa Top 50 Index. So it's the index of what you can expect the fund to look like in reality. But we'll go into some more details. Number of holdings, 53 securities. It's a bit weird. It's a 50 index, but they're 53. We can jump into some of that details a bit later. But that tells you how many shares are in your actual portfolio, the number of holdings. The next very important thing is the TER. Now, TER stands for total expense ratio. And what it means, it's a ratio of all the fees inside of the fund. As it suggests, it's total in nature. And the next one is the annual management fee. So what is the TER? Why is there a difference between the annual management fee and the TER? And the difference is because an annual management fee is what the asset manager is paid to run the actual portfolio. Out of that, they pay a whole lot of fees. So they'll pay S&P Dow Jones, they'll pay the asset administrators, they'll pay all the costs, the Bloomberg costs, all the data terminals, etc. So that's an all-inclusive fee for running the portfolios. But why does the TER get to 0.26 when the management fees are only 0.2? The first reason is VAT. So 15% of 0.2 is about 3 basis points. So that immediately takes you to 0.23. And then the difference between 0.23 and 0.26 is the custody fees. So the custodian is the person who safeguards your assets, the shares. They actually hold the shares on your behalf, and they charge a fee for that. The audit fee, so every year we must have an audit firm come and audit these portfolios to make sure that what we're telling you as an investor is actually what's happening in the portfolio. So our auditors are Deloitte, our custodians are Societe Generale, which is a big French bank, one of the biggest banks in the world, and then the trustee fee. So the trustee's job is to make sure that the mandate of the fund is actually kept in check, and they ensure that we're managing the fund appropriately. So that's why you'll see a management fee and a TER are slightly different. So that's nothing to be to kind of alert you, but just so you understand why there is a difference. I'm sure sometimes you've looked at that and wondered why the management fee or that maximum annual fee is actually lower than the TER. The next thing is the share code. So that's what you're going to tap into your easy equity platform to try and fund the security. And then, as I said, a lot of the stuff is quite self-explanatory. So original price, current price, etc. Tracking error is a bit of a challenging one for a lot of investors to get their heads around. Tracking error is a very statistical measure. It's a requirement from the FSCA to have it on our fact sheet. And tracking error, by definition, is actually the standard deviation of a fund's return relative to the benchmark return. And what it means is, in statistics or in statistical terms, it means there's a 2/3 probability that the fund will have a return within 0.54% of the benchmark. So it's a statistical term, and it's quite complicated. It's not what most people think, that the fund will underperform the index by 0.54% a year. And I'll show you why it's not that, but it's actually a statistical measure, which is a requirement. So trying to understand tracking error, you just hit it on Google. Investopedia has some nice explanations around tracking error, etc. The next important thing is distribution dates. Distribution dates are important if you're retired or if you need income. You need to understand how frequently the fund is distributing. So how often is it paying out income to you as an investor? So this is a quarterly distributing funds, and those are the particular dates. Historic yield is the yield of the fund, so the kind of income you can expect from the fund size, the shares in issue. That's just all informational. So this fund has about 900 million under management. And there's the trustee I was talking about. So that's really important. The trustee is the guy who's really looking after your money, is independent from CoreShares. The market maker is the guy who's making a double in the security. So all of this stuff is just for your information. And then something quite important is the risk profile. So if you're making your first time investment and you see this is aggressive 5 out of 5. Now, to give you an idea, a general guidance on what does that mean, it doesn't mean that this fund is taking huge amounts of risk. The whole point of ETFs is to be diversified, so you're not taking huge risks like buying one share. But remember that this is a risk profile as relates to all funds, not all investments. So as a general guideline, you can imagine cash is 1, bonds are 2, multi-assets, so in other words, incorporating cash, bonds, and equity in your portfolio is 3 and 4, and equities are 5. So any investment into shares is aggressive. Its risk profile should be around 5 out of 5. What's a bit confusing with these risk profiles is that some people have different views on risk. So some people might say, because this is well diversified, this is 4 out of 5 risk, but we mark it as aggressive. So this is kind of a snapshot that you'll see on most fact sheets to give you an understanding of what's actually in this fund. And in fact, if you just stopped right here, you'd have a really good idea of what you were investing in. And a lot of people just gloss over this and don't look at the details, but there's a lot of important information inside of this initial, if you want to call it, part of the thing. There is a question here. I just want to see if I can maximize this so I can read it. Do all ETFs require an MDD in terms of CISCA? Absolutely. What you do need to so CISCA, for those listening, is the Collective Investment Schemes Control Act. It's the act that governs unit trusts and ETFs. And so one of the requirements of the FSCA as relates to the actual act, the CISCA Act, says that ETFs must issue at least quarterly fact sheets. We do it monthly, and we also do a special quarterly report, which is a requirement, and we'll go into some of those details. So absolutely, it's a requirement of CISCA. There's no strict deadlines around what your time lapse is. We try and get our fact sheets out within the next month. So if it's a June end fact sheet, you should be able to see it by, say, mid-July. And there's a lot of work that goes into here, and you also have to lodge it with the FSCA, then they have to approve it. So behind the scenes, there's actually a lot happening here that you as investors may not see. But yeah, absolutely, you've got to. The reason why I say there's a caveat there is not all ETFs are actually CISCA funds. In other words, not all ETFs are SISCA funds, and the ones that aren't SISCA funds are typically the commodity ETFs. So those might have different regulations around exactly what they can and can't show. So I'm just going to see if there's another question here. It's talking about bundles. Shaun's here. It talks about if there are, sorry, we're just struggling to read the questions. So if I've bought a bundle in the Easy Equities platform, and it contains shares and ETFs, would I look to see the fact sheet for each ETF that comprises of your bundle? So, I mean, I can jump in that. Yeah, you can look at it. You can go and look at the underlying, understand what's in your bundle. It's always a good idea to understand. I don't think the bundles have fact sheets themselves. But that's a great idea to actually, if you're interested, if you're curious, if you see something that looks a bit strange, go and understand what's in your bundle. That's a great idea. Absolutely. So moving on to the next part of the fact sheet. So that was the quick facts, as they call them. The next thing is performance, etc., constituents, distributions. And you'll see here, this is most performance stats. And what's probably the most important from an investor is because we know past returns are not a good indicative or a good indicator of future returns. But what's quite important, and this is an FSB or FSCA requirement, is that you show the lowest 12-month return of the fund or the ETF and the highest 12-month. So you can kind of get an idea of what kind of risk you are taking on as an investor. So that I think is a good thing to look at. The returns are of course important, and what you'll see here is that it's the actual ETF versus the index. So this is where that standard deviation number is telling you something. As I said, it doesn't necessarily mean you're going to underperform the index, but you should be performing just about in line with the index. So since inception, which is over 3 years, this index has returned 6.1%. We don't put a lot of decimals, and the fund has performed 6.2, but they're pretty much the same thing. You can think of them as about the same thing. The differences come in efficiency of tracking, etc. So you'll see what you can typically expect is that TER minus the index gives you the ultimate fund return. So that's performance. That's how you understand it. And as I said, the lowest 12 and the highest 12 is actually an important indicator of what you can expect as an investor. The next thing is to have a look at the constituents to try and understand what actually makes up your portfolio. So this is a good way of trying to understand what's in the fund. Narina Visser, who's a miniature celebrity in the South African investing market, always says it's all about understanding what's in your portfolio. So you need to look through to the actual shares you're buying. So what you must remember is when you're buying an ETF, you're actually buying into the underlying shares that are in the ETF. So in this instance, this is a top 50 fund, so there are actually 50 constituents. We always have our constituents on our website. It's not a requirement to have them in the fact sheet, but it is a requirement to have them in the quarterly report. So we'll chat about the quarterly report where you get all of the fund underlying share details. But it's good to have an understanding. Let's say you are a client of Easy Equities, and before you bought the top 50 ETF, you actually had a big position in Naspers. So half of your portfolio, you held 50% Naspers, and now you're buying this ETF to diversify, but there's already 9% in Naspers. So you need to understand on a look through, either you need to sell down some more of your Naspers, or you need to understand, you just need to understand what's underlying. We'll answer some of the questions towards the end of the webinar that aren't really relevant to the point in time. The next thing is to look at distribution. So what has the actual ETF paid out? So this is the quarterly distributions. And you'll see here it's all in cents per unit. So the last distribution was around 16 cents per unit. The one before that around 25. And you'll see it's quite variable. And the reason it's variable is because the distribution is based on the underlying share dividends that are paid out. So every time one of these shares pays a dividend, the fund sits on that dividend till the end of the quarter and then pays them out. So this gives you a good idea of what this fund has actually paid out in distributions over the last, or since inception, over the last 3+ years. And then this is, again, very important, is the asset allocation. So this is a requirement. We must show what you're actually buying. And you'll see here, what you're buying is predominantly equities. so listed shares. And then there's a small part of listed property, and those listed property companies have qualified because they're in the top 50 largest shares on our market. So it's shares like Growth Point, Redefine, etc. And those only make up around 4.5% of the market. So this is a really important part to have a look at if you're trying to understand asset allocation. If you're making asset allocation decisions, etc., you need to have a look through to what's in your actual portfolio. The next slide, which we're going to have a look at, is the quarterly report. So that what I've spoken about up till now pretty much covers the fact sheet. As I said, it's mostly really simple stuff, but if you dig into the details, there's really a lot of information there. Now, the quarterly report is something that's required for us to put out there. We typically do it at the end of each distributing quarter, so March, June, September, December. And what it shows you is the full detail of the underlying shares. So in other words, it gives you a full detail of exactly what shares. It gives you a net asset value per unit, which is the same as the above, and that's usually for the end of the period, so April to March in this instance, and you will see that's at the end. And what you can see here is the share movements. So this is 31 March holdings of Anglo American was 6.81% of this fund, and at the end of June it was 7.42%. So you'll see within the fund, the share percentages are moving for various reasons. Some of these moves, and just because the share price moved, so in this instance, Anglos had performed well. So you've got a larger proponent of your portfolio sitting in Anglos at the end of June than you did at the beginning of March. And it gives you a good idea of how shares have performed over the last quarter, especially in a market cap weighted fund. What you might see is when a share in a fund like the top 50, who caps the largest single share exposure at 10%, you might see a share like BHP Billiton, which was at 10.38%, suddenly cuts down to 10%. And that could not be because of share performance, but because of portfolio construction. An interesting one is to understand where there's been a change. So I'm going to go on to the next one. And you'll see here, we've just highlighted a change here. This is due to a corporate action. And what's happened here is, if anyone was following Old Mutual PLC, which was JSE listed, did an unbundling. And essentially, they split Old Mutual PLC into two companies, Old Mutual Limited, which was the South African incorporated Old Mutual that we're all familiar with, and then Quilter PLC, which related to their UK-based asset management businesses. So you'll see at the end of June, we held no Old Mutual PLC, but what had happened is that we had an unbundling in our portfolio, and for every one Old Mutual PLC we received Old Mutual Limited and Quilter PLC. So combined, they pretty much get you back to your Old Mutual PLC weighting. So although there's a massive change in Old Mutual weighting, what you will see is that, in fact, that has been now included still in the portfolio as relates to Quilter and Old Mutual Limited. So it's good to understand what's happening in your portfolio. Was it a corporate action, or was it an instance where a share has been excluded from the portfolio altogether? And that pretty much wraps it up on what the fact sheet. As I said, there's a lot of information if you dig down into the details, but this is an important part. You'll see these long disclosures on all fact sheets. But what you really want to see is who's the trustee and the custodian. Is it independent? And that's a requirement from CISCA. You want to see that it's a collective investment scheme. Someone was talking about collective investment schemes. And you want to see that the investment manager is an FSP provider. So in other words, they're a financial services provider. And you can actually go onto the FSCA or the FSB's website, type in that number, and it should pop up and say, CoreShares Asset Management Limited is a Category 1 and Category 2 financial services provider. And if you go in there and you put in 46695 and you don't find anything, then that's a massive red flag. But as far as I'm concerned, all of the ETFs are really safe. There's nothing really to worry about. But if you see a funny or an unusual looking fact sheet and you want to do some digging, you can actually cross-reference this on the FSCA website. So we've got a couple questions. One is around, is Easy Equities looking to create a Bitcoin ETF? I'll hand that over to Shaun Um, if you are looking to do something with Bitcoin, I would rather come to you for that pays in, so you can long and short it. Yeah, I mean, to be clear there, Katlejo, there's a bit of um, a, a bit of an as someone says they can't hear Shaun. The long and short of it was that Easy Equities is not an ETF provider. They're a platform where you can gain access to ETFs, but you can actually buy the exposure to Bitcoin through their sister company GT 247. So that's the short answer. A Bitcoin ETF doesn't really. That would be what you would rather buy a cryptocurrency ETF, which gives you exposure to multiple cryptocurrencies. That's the concept of an ETF. If you were buying a fund that just gave you exposure to Bitcoin, you might as well just go and buy Bitcoin. So, there's a lot of lingo around Bitcoin ETFs and stuff, and I think people need to consider exactly what they're investing in. Do all ETFs have distributions? Question from Zane. No, they don't. So that's why I said you need to understand if your fund is distributing class or not. Quite a lot of the new international ETFs which have come to market don't distribute. And then it will say there'll be no distributions in that fund. So no, not all ETFs do distribute. So that's a great question. And that's one of the details that you should find right up in the front in the quick facts. And that's important. Sometimes it's actually attractive not to have distributions. If you've got a 30-year time horizon, you don't need the income. If the ETF provider is just reinvesting for you, that's great. But if you need the income, then distributions are a good thing. So we've got that's it with the questions. If there are any more, please shout. We'll hang around online for the next couple minutes. So thanks so much for joining us. If you have any questions, drop CoreShares a question or drop Shaun, the Easy Equities guys, a question. We're more than happy to respond. We at info@coreshares.coza. We'll get back to you. But we hope this was useful. As I said, it was meant to be really simple and really short and sweet. So yeah, shout if you have any questions. We'll hang online until around for the next 5 minutes or so. So if you feel like you want to ponder on a question, and let us know. Okay, cool. We've got a question from Brandon. The question is, how long should one hold an ETF generally? I'm glad you put in generally because I am gonna speak generally. It depends again. So if we go right back to the beginning, let me see if I can actually scroll us back to the beginning. What you need to understand, what's really important, is the asset allocation of your fund. So what kind of underlyings does that ETF hold? So, and also what's an important indicator is the risk profile. But typically, the general rule of thumb is the riskier the underlying, the longer you need to hold it for to lower the probability of having a bad investing experience. In other words, investing at the wrong time and then you lose money. So like equities or shares are typically a long-term investment horizon. So 5+ years, I would even say 7+ years. But if you were buying a cash ETF, you could hold it for 2 or 3 days. A bond ETF for 1 to 3 years. A multi-asset ETF for, depending on the asset allocation, let's say 3 to 7 years. So it really does depend. It really does depend on what the ETF's underlying is. We've got a question from Michelin asking, how can an ETF outperform the index that it's linked to? It can, depending on the management efficiency that the asset manager ekes out. But generally what you should expect, and what we always tell clients, is you should expect the index return approximately minus the TER. So that's what you should expect. What sometimes happens in ETFs is ETF managers can eke out efficiencies. There can be a corporate action where, let's say, NASPER says, okay, we're either going to give you a distribution in cash, or we're going to give you a distribution in specie, in other words, underlying shares. And to incentivize you to take the underlying shares, we're offering you that specie at a 5 or a 10% discount. The ETF manager then has a discretion to say, okay, we'll rather take the underlying specie at a discount, sell it, and make a slight profit. And usually that's where the difference comes. But you can basically expect index minus TER long term. That's what you should be expecting. What's the difference between TER and EAC? So the difference basically is, and the reason why we don't have an EAC on this fact sheet, and I'll jump into the details. The EAC is the effective annual cost, and that includes brokerage. So EAC is actually not very clearly defined in terms of ETFs specifically. It was a measure that was launched for unit trusts, and so you will see that there's no EAC on this particular fact sheet, but EAC includes transactional costs. So that's what this excludes. The best way to establish what the real cost of holding a fund is to take the performance of that fund minus the benchmark, and then you get the best understanding of what the performance or what the real cost of holding the fund is. As an investor, you also need to understand with ETFs, or what are your brokerages you're paying through, say, Easy Equities or any online. But that's where the likes of Easy Equities are real cost leaders. In other words, you're getting cheap brokerage, so you need to understand that kind of stuff. Are there minimums to invest? So there's more to it than just the cost of the ETF. There's a whole chain of costs that you are experiencing as an investor that you need to get a good grip on. So that's the difference between TER and EAC in a nutshell, is the transactional cost component of the ETF, and that comes over and above the TER. Do all ETFs and unit trusts pay dividends? It differs ETF or unit trust by unit trust, or ETF by ETF. So this is an example of a quarterly distributing fund. You might get annual distributions in funds. You might get semi-annual. You may even get monthly in some funds, or you might get none at all. So it really does differ. And they don't have to pay distributions. I know there's no strict guidance on that. Why choose an ETF over a unit trust with the same holdings? It comes down to personal preference. So really, they're giving you the same exposure. Usually ETFs are more efficient tracking vehicles. In other words, they get closer to the index, but then what you have to consider is you have to pay brokerage to get into the actual ETF. So think about that. But at the end of the day, they give you very similar exposure, so there's not much in it. ETFs are really cool because as an investor, you can hold an ETF alongside your investments in shares, in cryptocurrencies, etc. So in bundles. So that's why ETFs are growing, because they're really flexible. You can buy them on the exchange, you can trade them intraday, and that's typically why there's been the shift towards ETFs. A lot of clients who are already investing have stockbroking portfolios in the market. So rather than them opening a CoreShares account in the unit trust vehicle, so as an example, we have a unit trust that tracks this exact index. It's got about 500 million Rand investing, and usually that's more typical advisor market who buys that. The direct retail investors, the guys who are doing it themselves, are buying it through an Easy Equities, and they're doing it because they've got a little stockbroking portfolio, or they've got a big stockbroking portfolio, and they want to just hold some ETFs alongside their shares. So it really comes down to preference. And the benefit of holding everything on one platform like Easy Equities is that from an administrative purpose, or from an administrative perspective, it's really easy. You've got everything on one platform. So Susie Orman, who's like Oprah Winfrey's financial guru, says that ETFs are the mutual funds or unit trusts of the 21st century, and it's because of the flexibility. So you'll see a lot of robo-advisors are investing into ETFs, etc. The bundles, for example, you couldn't really at this present necessarily plug in a unit trust from Alan Gray and one from Coro, and it becomes very complex. ETFs are super user friendly from that perspective. Thanks, guys. And that looks like, oh, we've got another question. That's great. Keep them coming. If you're new to ETF investing, how often should you monitor your investments? Um, so, what you need to do if you're new to investing in general, ETF investing or share investing, unit trust investing, is to try and understand what your objective is. That's the first. That's the first place to start. What advisors call it is a needs analysis. So they're trying to understand what you're trying to achieve. Then you want to align what you're trying to achieve with your particular investment. So let's use the simplest one, and I'm going to use a simple one. Let's say you want to achieve long-term growth and you've got a 20-year horizon. So you don't need that money for short-term debt. You don't need it because you need to pay school fees or anything like that. You can actually lock this money up and put it away. You're generally going to be investing in equities, both local and foreign. So let's say you made an investment into the CoreShares Top 50 ETF, and you made another investment into the CoreShares Global Dividend Aristocrats investment. That's the kind of investment that you could actually forget about, have a look at it once a year. And what you want to look out for is things like, have there been distributions? Should I be reinvesting those? You want to look out for things like, is this fund growing? Or is it shrinking? What's the TER? Has that changed? So, with ETFs, the beauty of them is they're really light touch from an investor perspective, which is very different if you're buying a basket of shares. If you're buying, say, 5 shares that you need to invest in, then you really need to monitor it carefully and understand it. But what we would encourage is investing over long terms, of spending time on the markets, not trying to time these things. So coming in and out is usually destructive, value destructive for investors. But the short answer, it depends on what your objective is. But you should monitor it, let's say, every 6 months, have a look. Is it still in line with what you're trying to achieve? And then go for it. Is there something better out there? That kind of thing. And then take it from there. Usually, the great opportunity for investing in ETFs or in shares or anything is actually to use cash flows to realign your portfolio. So let's say you said, okay, I want simple exposure to the JSE. I'm going to buy the top 50. That's my only thing I hold in my portfolio. But at the end of the year, suddenly you've got a 13th check from your employer, and you've got 10 grand and you want to invest it. Go back, sit down, look, is this still aligned with my achievements? No, actually, I want some offshore. Okay, I'm going to go buy an offshore ETF. So usually cash flows are a great way to realign your portfolios as opposed to buying and selling. Got a question that says, what will happen to my portfolio when there's a recession? I guess you're referring to the technical recession that we are in South Africa at the moment. Again, all of this stuff depends on what your portfolio is made up of. We've got clients who are asking, why is my portfolio performing so well? We're in a recession. And when we look at their portfolios, we see that all of their portfolios invested overseas. So they invested in the S&P 500 and a global property and a world tracker. And all of their portfolio is actually invested overseas. So there's not much South African incorporated risk. Even our top 50, like this example, about 50% of these shares are actually driving their returns, or their earnings are driven offshore. So there are disconnects between where you're investing and what the actual underlying is. So that's why it's so important to understand what is inside your ETF, and there's no better way to do that by looking straight through to the underlying. So in an example like this, Anglo-American PLC, listed on the London Stock Exchange, primary listed, BHP Billiton, mostly an Australian play, British American Tobacco, a global tobacco play. So, buying a South African equity ETF, Quilter PLC, is UK asset management. Doesn't mean you're buying South African incorporated risk. So you need to understand what's in your portfolio. In general, though, in the long term, if the economy is performing poorly, and then your equities, which are a reflection of businesses in the economy, will then perform in line. So as an example, to give you an extreme example, global financial crisis, we saw the economy in tatters globally, and you see drawdowns. In other words, your portfolio can reduce in value up to as much as 50%. The trick there is to stay invested through those. Now, that's if you're in equities. If you're in bonds, it will be a lower drawdown, so maybe 10%, and so on and so forth. So what we encourage is spending time in the markets. If you've got a 20-year horizon, and this year is year one, and we hit a recession and your equity portfolio drops 50%, a global recession, then what you find is that you've got time, so you should just stay invested. It usually is harmful to try and pull money out or invest more money. So the short answer is there's no direct link between recessions and equities, but in the long term, the underlying fundamentals of a market should play through in the performance of the companies which represent that market. So there should be a link. But in terms of the South African experience, we've got a massive disconnect between our equity market, like Naspers, which is 10% of this portfolio, is a Chinese tech play. Richemont, which is another close to 10% of this portfolio, is a European luxury goods salesperson who's predominantly growing their earnings in China and in Europe and in America. So, you need to understand what's in your portfolio really to understand what's going to happen if a recession hits South Africa or the globe. This investing thing is by no means easy. How's the top 50 performance compared to the more popular top 50 ETFs since the CoreShares launched the top 50? It's slightly outperformed, which is interesting. The primary value proposition here is you get an extra 10 shares. But the most important thing, and what you would have seen over here, is that no share exceeds 10%. So it caps the largest share at 10%. What that does is it improves the risk and the diversification of this portfolio significantly relative to a top 40, which has, say, 25% invested in Naspers. So it has actually slightly outperformed since inception, which is interesting because you think Naspers is driving all the performance, but in reality, there are a lot of other shares which are driving performance in our market. You say they're more popular, and they are more well known. But last year, the local ETF which raised the most money was actually this top 50 ETF. So, yeah, it's probably more popular and more well known, the top 40. But the money, the fund which has grown the most over the last year is actually this top 50 fund. It's gone from a few hundred million to close to R1 billion in the last year or so. So it won this. There's a new ETF awards called the Salter Awards. And it actually won that predominantly because of that risk control, that 10% risk control. So that's how we try and position it, is to say, giving you similar return to the top 40, hopefully better because you pick up an extra 10 shares over long periods of time, but with a lot lower level of risk. So your effective share exposure, the actual number of shares which drive your performance in this fund is around 25 because of the large shares, whereas in a top 40, it's actually around 10. So you've got effectively, you have exposure to more than double the amount of shares. And at the end of the day, that's what ETFs are about. They're about diversifying returns, diversifying away stock-specific risk in a portfolio. So I hope I wasn't too biased. I am from CoreShares. So we are talking top 50, but everything that I've mentioned there is factually correct. We're still waiting. We've got no more questions. We're probably going to wrap it up in the next few minutes. So thanks so much for joining us, guys. A big thanks to Easy Equities, to Shaun and his team. Hopefully we can come with more webinars. If you've got cool ideas, or if you've got ideas about what webinars you want us to actually create, we're happy to do that work and come back. And the closer we can get to you, the investors, the more we know what you're looking for. So drop Easy Equities an email, drop CoreShares an email. We'd be happy to help out. So thanks a lot for taking time out in your day. It's been recorded. It's going to be on the YouTube channel, the Easy Equities YouTube channel. So please feel free to circulate it. And I don't know if Shaun wants to sign off, but thanks so much from CoreShares. Hopefully we'll tune in soon.
Yeah, thanks.
Pleasure.